Please welcome Screener.co. So the first wave of innovation in the financial services industry brought stock trading to Main Street with the advent of the online discount brokerage. However, Wall Street's maintained a distinct analytical and data advantage. As you can see from the screenshots right here, the FactSet complex terminal above that costs thousands of dollars a month relative to the oversimplified products available to consumers today from Google and Yahoo Finance that strive for simplicity rather than robustness and complexity. Well, our goal with Screener.co is to create a Wall Street caliber data and analytics platform for Main Street. So let's jump into the tool. The first thing you'll notice is that our database contains tens of thousands of stocks from tens of thousands of global companies. Unlike other consumer products that are focused only on US and Canadian companies, if you're lucky, we have a full global data set. Also, if you browse the menus, what you'll see is that we have over 1,000 preset screener criteria. And in addition, you're able to create complex composite algorithms and complex composite formulas that let you create your own screener conditions on top of our pre-built conditions. So let's build a sample screen that's relevant to us here. Let's try to find some attractively valued technology companies. So the first thing we're going to do is limit our scope to the technology sector. Next, we want to eliminate micro-cap companies or other very, very small companies from the list. So let's get rid of any company with a market capitalization of less than 10 million and limit ourselves to only those with greater than 10 million market caps. Next, I know a lot of the risk-loving angel investors in this room like companies and are willing to invest in companies that aren't necessarily profitable yet. But for the sake of this screen, let's look at only companies that have positive net income in the most recent interim period. Now here's where things start to get interesting. What you're able to do is define complex custom formulas as your screener conditions that use our pre-built data points. So you're able to look for companies that have a total revenue per employee of greater than $500,000, even though that's not a built-in indicator within our data set. We have revenue in employees, and you can create the formula of revenue per employee. What this is designed to do is eliminate a lot of the less interesting low-margin services and manufacturing firms from this particular screen. So next, let's look at the valuation metric, at what we define as attractively valued. For the sake of this screen, let's set it as an enterprise value to EBITDA ratio of less than 10. A lot of investors use enterprise value to EBITDA as an alternative to price earnings, as it lets you value the underlying business somewhat apart from the capital structure. So current enterprise value to EBITDA is a built-in indicator, and you're able to use it here. Finally, we want to look at the health of the balance sheet, and we want to make sure that the company is unburdened by a heavy debt load. So let's use a pretty conservative screen and make sure that the total debt in the most recent financial statement is going to be less than their annual EBITDA. Very, very conservative metric. The reason we're not requiring total debt to be zero is in this low interest rate environment, a lot of companies are taking on additional debt to bolster their balance sheets for acquisitions or other strategic opportunities that they may want to pursue in the future. If you happen to be one of those companies, remember, Screener.co is our product, and that's what you're seeing right now. So if we sort our results in descending market capitalization, so we see the largest companies that people are most likely to be familiar with first in the list, you'll see that Microsoft, Intel, and RIM are all prominently displayed in this screen. Now, Microsoft and Intel, as you know, have been posting strong quarterly numbers recently, but their strong duopoly position in the personal computer market hasn't necessarily translated into an equally strong position in the tablet and mobile markets that are increasingly representing the future of computing devices. So that may be one of the reasons why they're trading at a bit of a discount. So let's compare the results from our current screen to some other technology companies that people here may be familiar with. Let's try Google, Apple, and Yahoo. And we can create in our stock list view any stock symbols that we want to enter from the data set in any of the global companies. And once we've added those companies, what we're going to do is use a different view, one of the pre-built views, that looks at valuation, growth, and efficiency metrics. And we're going to change that view in both the results set as well as the stock list view, so that we can compare the companies that were returned by our screen to those that we know about and want to look as a point of reference. What you'll see is that the enterprise value to EBITDA ratio for Google, Apple, and Yahoo is significantly, significantly higher than that for Microsoft and Intel. In addition, if you look at the revenue per employee numbers, Google's revenue, or Apple's rather, revenue per employee at 1.4 million is roughly twice that of Microsoft. Now, if you want to question one of the reasons why they're more highly valued, if you scroll to the right in the stock list view, you can see some of the growth metrics. And you'll see Apple's been posting very strong growth trailing 12 months over the prior trailing 12 months, over 60%, which is incredibly impressive for a company of their scale. Whereas if you look at the growth metrics for Microsoft and for Intel, they're impressive, but not 60%. If you can, unfortunately, we don't have private company data in our data set, but if you were to look at Facebook, for example, at a $50 billion valuation with their estimated $2 billion of revenue, they're trading at 25 times their revenue, trailing revenue, whereas Google even is valued at 14 times its trailing EBITDA, or its profitability metric. There's many more data points in this data set, and the views are fully customizable. So if you want to see more, please stop by our booth. To close, we are Screener.co. We are a free public beta until April 1st, and everyone here is welcome to join. And then it'll be approximately $24.95 a month is what we're shooting for. We're running a referral program where you can refer friends during the beta period. If they become paying customers, we'll give you $10. My contact information is above. Feel free to stop by our booth. We'd like to talk with you. Thank you very much.
Awesome. Okay.
So if this doesn't work out, you can get a job as the fast-talking Micro Machines guy. I'm just saying.
Yeah. In rehearsals, we spent about 80% of our time together slowing down. He's at about 50% of his speed right now. There were twice as many variables covered in the Screener demo, and Mark Pesce was there. You can attest to that.
Which company am I supposed to invest in?
So one of the things we're deliberately trying to avoid is giving advice. We're trying to provide a powerful platform for investors to run their own strategies and determine what's right for them. In the consumer market particularly, there are a lot of newsletter subscriptions that are offered. So people are selling advice or recommendations. Our goal is to provide the platform and let people make their own decisions.
I think it's useful because I have to figure these little things out on my calculator by myself, unless you buy a really expensive program that you might get, which is useful. And thank you for clarifying the Facebook valuation situation for us. But you would sell to who? Who are you aiming for? Because most big companies have this kind of data
Right, it's not
available.
for institutions, it's for sophisticated retail investors. So there was a report put out.
Schwab could offer it, for example, to their...
Right, so there was a report put out that says that about 14% of US households have between 100,000 and 1 million of investable assets. And 20% of that group are entirely self-directed investors. They make all their own investment decisions. They don't consult professional advisors. So that would be sort of the natural sort of
How would you
ideal.
get to them? Through a Schwab or
Yeah,
an
so
E-Trade?
it's a combination of direct marketing to consumer on the internet as well as partnerships with financial portals, brokerages, and investor education firms.
So my personal opinion, since I started Mint and it's in the space a bit, it doesn't seem differentiated enough from the stock screeners you get for free from even MSN that they've had for 10 years, where you can get almost all of these. It's nice that you have equations and some other bells and whistles there, but it doesn't seem differentiated enough. And when we look at our customers, most people, the general population, even the people who have over $100,000 in assets, have difficulty picking from among the 10 investments in their 401k. The way to go in this market is not more complex, it's actually simpler. So if you look at guys like Eggnest.com or Plantly.com, they ask you 3 questions. Like, how old are you? How much do you have to invest? And then here's a slider for your risk tolerance so you can see, this is how much I might lose if I go too risky, this is how much I might gain, here's my sort of expected return. That's the kind of thing that consumers can handle, and that's the way the industry should be moving. In my opinion, not this way.
I think that's exactly right. I'm worried that you're building a prosumer tool rather than a consumer tool, and in my experience, prosumers almost don't, if they exist, they're almost impossible to find through any traditional marketing channels or otherwise. So I echo that completely.
Do you have any plans at all to make this a little bit more consumer friendly with tutorials or anything that can bring someone up to speed on how to use these tools?
Yes, so there's a sales website that's under development right now. Unfortunately, it wasn't able to be released on time. It will have tutorials, forums that people can ask questions in, as well as sort of a direct support ticketing system to answer questions directly if it's not in the forums or the tutorials.
I'd think about a UI solution, and this is kind of to what Aaron did so effectively at Mint, but you know, there's a lot of powerful data that you're crunching underneath here. How can you present that in a layer to consumers that's far simpler and requires them to make far fewer decisions? Because I think that's sort of the issue for them, is having to make too many decisions, frankly, if you want to reach a broader consumer market with the tool.
And there are a number of companies that are going after that market, several of which were mentioned earlier. I think the objective here was to go after the underserved market, which is more of the prosumer segment that you mentioned before.
What if, this is Jason, what if you allowed the prosumer people, which is a small group but a powerful group, to publish their screens on a website frozen in time, so that you could then see 3 months from now, 6 months from now, if this actually resulted in a positive or a negative gain, and just put a comment thread underneath it. So then I could, you know, I'm a geek in that screener, and then you just hit publish, it publishes. and other people could then create a conversation around your thesis and check back on it 6 months from now, a year from now, 2 years from now.
So there is a screen sharing capability built into the tool itself, and that's part of the sales website. Is there's a thread created for each one of the included screens so that you can track and discuss it over time.
Yeah, Mark Pesce has a suggestion. He thinks you should meet up with the HiveTrader folks, and then you guys should just join forces, because you've got this incredible prosumer stuff, and they're working on a sort of Mint, UI piece. Maybe you guys can work together. Jose from the group has a question about design and how important it is.
Yeah, it's awesome to have Aaron say about the visual. And just the insight I was just going to note in the question, we've been advising the actual large banks, and they're into data visualization and looking at what consumers are doing, even at the pro level. How are you going to go to the next step in terms of the UI? Because I think it's definitely very dense.
Mm-hmm. Well, I think one of the objectives was to capture the full complexity in the terminals that's used a lot on the professional side and make it more readily available. So I don't know if we want to oversimplify as some of the competitors have, just in the interest of making it less complex or more simple. We do want to add more visualization tools to it, though. There are sort of graphing libraries available that we want to integrate so you can view the fundamental indicators both over time and against each other.
That's what I mean.
Yeah.
Visualization, not less complexity. Mm-hmm. Okay. Kara, what's so important on the computer?
Oh, I'm just getting threatening emails from Ariana Huffington for appearing on this panel.
Oh. Hey-o. There's a little inside baseball. Let's hear it for Screener.